now we're going to talk about assets. We already spoke about the balance sheet, and we said that the formula for understanding the balance sheet is that assets equals liability plus equity, and we emphasize that assets are the resources that a company possesses or a company has. So now we're actually going to see what those things are that a company would usually possess in order to be productive. Again, it's very important that you see the monetary value of all of these resources. So I'm going to uncover, I'm so excited to do this part in the Red Sea, and reveal my handmade asset sheet. So that's definitely a made-up term. Usually you have a balance sheet, but right now we're just going to focus on the asset side of things and taking step by step. And again, if you want to get more comfortable with this, you could definitely log on to Yahoo Finance or Google Finance or whatever resource you'd like, and just look up the financial statements of publicly traded companies. So for our benefit, we're just going to get started with some things that you would generally see be reoccurring characters. Again, accounting is a story of a business, so what are some characters that usually would be reoccurring? So number one, cash. All right, cash. Before I even talk about current assets, just think cash. Cash is king. The reason I say cash right away is because our asset side of a balance sheet is going to be organized in terms of liquidity. So how close to being cash are you? There's nothing closer to being cash than cash. Next, we're going to have our cash equivalents. So things that might as well be cash. If you have some of your money in other currencies, so we're in the United States right now, if you decide you want to keep some of your money in euros, it might as well be cash, because by tomorrow you could have that in dollars. Accounts receivable. People have already paid for your goods, they just owe you the money. So within a year, and I'm going to talk about the within a year part, you know that you're going to get that money back, or at least you're crossing your fingers that you will. Inventory, things that you have, things that a company has that it plans on selling for cash. And then prepaid expenses, I'm going to talk more specifically about that, about them in a different video. But for right now, just understand that they are current assets. All right, so the current assets, why do we make this delineation between current and long-term assets? Well, that's because current assets are things that we believe we can turn into cash relatively quickly. And by quickly we mean within a year. That's very important when we talk about finance or just financial statements. Anything that's attached to current, at least I haven't come across anything that breaks this rule. Current anything is within a year. So again, cash is king. Within a year, cash is already cash, but we know within a year we're going to be able to turn cash equivalents to cash, usually within a day. Accounts receivable, usually within about a 30-day period. Inventory, again, usually within a 30-day period. It's just what you intend to sell. Hopefully you're good at your business and you're good at selling the things you plan on selling. And prepaid expenses, I do not want to muddy things up, but just to give you a quick idea of why they are current assets, it's expenses that you pay for ahead of time. And if you realize that the person is not going to deliver on the good or service, you're able to reclaim back your cash relatively quickly. So current assets, these are the key players for current assets, and obviously I have the monetary value. So it's very important. When we started the series, I said look at every single thing and try to understand the monetary value of it. And now you see why. We have to get good at understanding that things have a monetary value. If they don't, they have no place in accounting. So let's just cut out the middleman and start thinking, how much is this really worth? After current assets, we have our long-term assets. So let me just actually mention that on the balance sheet, we're going to add up the current assets. It's very important, especially when it comes to doing certain ratios, for us to have this all together. How much in total can we turn into cash within a year? Because again, we're borrowing money to pay for the things we have. So in case we need to make emergency payments, we need to understand, all right, this is the amount that we have available in case we run into any problems. So cash obviously is the most readily available, but there are other things we can turn into cash within a short period of time to meet our needs. Long-term assets. All right, this is the word capital gets used in so many different ways, but they're my top two favorite ways. This is my second favorite way of understanding capital. Your long-term investment, your fixed assets, so things that you purchase that you plan on using in the long run, and they're going to be difficult for you to sell right away because number one, if you're a successful company, you don't really want to sell these, but you don't plan from the time of purchase or from whenever you're actually looking at your balance sheet, you don't plan on selling these within a year. So your long-term assets will include land, and that's just real estate that doesn't have a building on it. Sometimes it will include the resources that come with the land. So if there's oil in it, if there's water, any of those other resources that are productive, well, those are technically commodities, but especially oil, you may also be entitled to the benefits from that. So that's what land is, real estate really without any property on it. And then we have property, plant, and equipment. So think a factory, all right? When you step outside a factory, there's a building there. And then when you go into the factory, you see a bunch of equipment there that are busy making stuff that we're going to sell. So those are also long-term assets. They're busy being productive for us to make things that we can sell. But unfortunately, or maybe fortunately, we cannot sell them very quickly. Okay? And then the next thing we're going to look at is accumulated depreciation. They go hand in hand with property, plant, and equipment. Don't fool yourself to thinking that land always appreciates. We're just going to leave it out of the conversation for right now. But typically, when we start looking at property, plant, and equipment, PPE, people just keep them together, you're going to worry about the depreciation because there are things you're going to replace. They're going to become outdated, they're going to become worn, and they're not going to be worth the same. If I paid $1,000 for some equipment, in about 3 years it may only be worth, I don't know, half of that or whatever the case is. But we're going to go over straight line depreciation to show you how to actually calculate the worth of property, plant, and equipment. But for right now, just remember that our fixed assets come with land, property, plant, and equipment, and property, plant, and equipment tend to depreciate. And if you see a parentheses on any financial statement, it means you're going to subtract. All right, that's kind of that's the code in the accounting world. All right, so these are standard. And then there's goodwill. I included goodwill just because I don't know. I have certain characters. Again, this is a story. I have certain characters that I fall in love with, and goodwill is one of those characters. So you usually see goodwill especially come up when there's an acquisition. So if I decide to buy another company, but let's say your company, because you're so good at starting up businesses, but when I do the math, all your assets only add up to $1 million. You only have $1 million worth of assets, but I'm paying you $2 million. So where's that extra million coming in? Well, we have to take into account your expertise, all the people you've hired, the fact that people like you, you have strong brand value, and you have great market share. So there are other intangibles that we cannot really easily quantify. And that usually goes into goodwill. But for me, I like the word goodwill, and I like to think if I'm exceptionally productive and efficient and I do right by my customers in delivering value, I will increase my goodwill. And that's the X factor usually, especially when it comes to selling a company. So I never leave that out. And then intangible assets, we usually kind of leave that more for intellectual property. So that'd be your trademark, and again, they're definitely worth a lot of money. So let's look at trademark and patents, but specifically trademarks. If I buy a shirt from China today and I sell it on the market, so let's say the shirt costs $2 to make, I sell it for $4. Disney takes the exact same shirt and they put a Disney logo on it, and all of a sudden it's worth $10. So you can see how trademarks are really important, and that's more intellectual property. Other assets, I left it absolutely on the bottom just because it differs from company to company, from industry to industry. Usually you'd have to look specifically in their financial statements and actually dig a little deeper to see what they include in their other assets. Usually it's just things that aren't very standard that they plan on selling for some money. And more commonly, you'll see them actually split into other assets, other current assets, and then they'll be on the top right here, or they'll just leave, the accountant might just leave them on the bottom if they just plan on selling them at some point. But let's say it's some equipment that's rarely used and it's not very common in other industries. Instead of including it as something that you're going to that's more, let's say, familiar to people, you're just going to include it as other assets because you don't want to start confusing people, and we get the idea that you're planning on selling it off within the year. Okay, so that's how that works. It's not a key player when it comes to accounting, especially when you're trying to strengthen your fundamentals, but I thought it was important for us to actually include it here. So altogether, the key to remember on the asset side of the balance sheet is that every character here is organized in terms of liquidity. So the green on the very top is cash. How close to being cash are you? There's nothing closer to being cash than cash. And then as you go down the list, it gets harder and harder to liquidate. And that's what it means to liquidate, to turn whatever that asset is, whatever it is that you have, into cash. And now you see why it's so much easier if we just start to see everything that a company possesses in terms of the monetary value. Okay, I don't think I really missed anything. Oh, actually, yes, I did. So I just said the monetary value, and we can just go down the list here. I have the monetary value for all the current assets, all the long-term assets, and we'll just call them other assets. And on this sheet specifically, it adds up to $181,000. So when I actually put together our balance sheet in another video, we're going to take this exact same asset side and try to figure out how it is that we paid for all these things. So remember, we possess this assets. We have this. These are things that we're going to use to make our company successful. They are resources. They have monetary value. In this case, $181,000 worth of value. But how did we pay for all these things that we have? And that's what we're going to talk about much later. But on the next couple of videos, I'm just going to take apart all these characters just so you could cement and have a very natural understanding of what it is they are. Okay, and that was assets. Thank you so much.